On December 27th, 2025, just 2 days after Christmas, JP Chase filed an emergency SEC Form 8K disclosure that sent shockwaves through global financial markets. The nation's largest bank revealed an unrealized loss of $4.875 billion on silver derivative positions, a number so staggering it demands we ask a single question. How did the most sophisticated financial institution in America find itself on the wrong side of history's greatest commodity squeeze? The filing came late Friday night, the traditional time when institutions bury news they hope the world won't notice. But this wasn't just another quarterly loss or regulatory fine that could be absorbed into the noise of corporate America. This was an admission that decades of market positioning, billions in trading profits, and the confidence of the entire banking establishment had been shattered by a metal most people associate with jewelry and silverware. Throughout financial history, certain patterns repeat with almost mathematical precision. Markets that seem controllable suddenly become uncontrollable. Assets dismissed as relics transform into instruments of systemic crisis. Banks that appear invincible reveal themselves to be remarkably fragile when leverage meets reality. The precious metals markets have always operated at this intersection of confidence and chaos. Unlike stocks or bonds that derive value from corporate earnings or government promises, gold and silver possess something financial engineers can never quite replicate: tangible scarcity. You cannot print more silver into existence with a keystroke, cannot dilute it through quantitative easing, cannot decree it into abundance through monetary policy. This fundamental characteristic has made precious metals both a refuge and a battleground throughout economic history. In 1980, the Hunt brothers of Texas attempted to corner the silver market, accumulating over 200 million ounces of physical metal and driving prices from $2 per ounce to an inflation-adjusted peak of $49.45 in January of that year. Their strategy was simple: recognize silver's finite supply, purchase as much physical metal as possible, and watch as industrial demand collided with scarcity. But the establishment fought back with rule changes. On January 7, 1980, the Commodity Exchange implemented Silver Rule 7, drastically limiting the size of positions traders could hold and effectively making it illegal to continue buying. On March 27, 1980, a day now known as Silver Thursday, the market collapsed, silver plummeted below $11 per ounce, and the Hunt brothers faced financial ruin. The message was clear: the system would not tolerate individuals disrupting the established order of commodity markets. What happened next is what always happens after such dramatic events. The financial world concluded that silver had been dealt with, that the lesson had been learned, and that no one would dare challenge the system's control over precious metals again. For 45 years, silver remained subdued, trading in a range that seemed to confirm this narrative. Investors moved on, regulators relaxed, and the major banks, particularly JP Chase, began building the largest derivative positions in history, confident that physical demand would never again threaten paper supply. They were wrong. The crisis that erupted in late 2025 had been building for 5 consecutive years, hidden in plain sight within supply-demand reports that few analysts bothered to read carefully. According to the Silver Institute's World Silver Survey, global silver supply has remained essentially flat since 2020, hovering around 1,030,000,000 ounces annually. Mine production in Central and South America, historically the world's primary source, has been declining due to resource depletion, infrastructure challenges, and the simple geological reality that high-grade silver deposits are finite. Meanwhile, demand has exploded. Industrial fabrication reached a record 680.5 million ounces in 2024, an 11% increase from the previous year. The driver is something economists call technological lock-in, when a material becomes so essential to critical infrastructure that no substitute exists at scale. Silver's unique properties, the highest electrical and thermal conductivity of any metal, superior reflectivity, antimicrobial characteristics, make it irreplaceable in solar photovoltaic cells, electric vehicle components, 5G telecommunications infrastructure, and artificial intelligence hardware. The solar industry alone consumed over 25% more silver in 2024 than in 2023. Each electric vehicle requires approximately 2 to 3 times more silver than a traditional internal combustion engine vehicle. Advanced AI servers, the backbone of the technological revolution currently reshaping global commerce, use 70% more silver than conventional data center equipment. These aren't discretionary uses that disappear when prices rise. They are structural demands embedded in multi-trillion-dollar infrastructure buildouts. The mathematics became inexorable. The Silver Institute projected the 2025 structural deficit at 115 to 120 million ounces, marking the 5th consecutive year of supply shortfall. Cumulatively, the world consumed approximately 820 million more ounces than it produced between 2021 and 2025. That silver had to come from somewhere, and increasingly, it came from the inventories backing paper contracts on exchanges like the COMEX in New York. By early December 2025, something extraordinary began happening at the COMEX, the primary futures exchange where silver contracts trade. Registered silver inventories, the metal available for immediate delivery against futures contracts, stood at approximately 140 million ounces at the start of December. Within 4 trading days, 60% of that inventory, 84 million ounces, was claimed for physical delivery. This wasn't normal market behavior. Typically, less than 2% of futures contracts result in physical delivery. Traders close positions before expiration, rolling them forward or settling in cash. But December 2025 was different. Industrial buyers, investment funds, and sovereign entities were no longer willing to accept paper promises. They wanted metal, and they wanted it immediately. On December 23, 2025, the CME Group, which operates the COMEX exchange, took an emergency measure that revealed the severity of the crisis. They doubled the margin requirements for silver futures contracts, meaning traders now needed to post twice as much collateral to maintain positions. Official explanations cited increased market volatility and prudent risk management, but the timing told a different story. The exchange was attempting to cool a market that had become dangerously tight, where the gap between paper claims and physical metal had grown so wide that the entire contract settlement system faced potential collapse. Silver prices responded accordingly. The metal that began 2025 at approximately $30 per ounce surged past $76 on December 27th, a 133% gain in 12 months. By year's end, silver was trading near $64, a level not seen since the Hunt brothers squeeze 45 years earlier. But unlike 1980, this wasn't driven by individual speculators. It was driven by fundamental supply-demand imbalances that no rule change could resolve. And then came JP Morgan's disclosure. The bank had been the dominant player in silver derivatives for over a decade, a position documented extensively in regulatory filings and enforcement actions. In 2020, JP Morgan paid a record $920 million settlement to the Department of Justice for spoofing and manipulation in precious metals markets, a scheme where traders placed fake orders to move prices, then canceled them before execution. The bank admitted to systematic fraud spanning nearly a decade. Despite this history, or perhaps because of it, JP Morgan understood the silver market better than any other institution. Throughout 2024 and early 2025, the bank had maintained massive short positions in COMEX silver futures, contracts betting that prices would fall or remain stable. These weren't speculative gambles. They were strategic hedges tied to the bank's broader precious metals trading operations, vault services, and derivative products sold to corporate clients. But something changed between June and October 2025. According to data analyzed by precious metals researchers, JP Morgan began systematically closing its short positions. By October, the bank had reportedly closed its entire 200 million ounce short position and actually went net long, accumulating approximately 750 million ounces of physical silver, the largest private stockpile in modern history. This reversal suggested the bank recognized something fundamental. The paper market structure that had allowed unlimited short positions backed by minimal physical metal was breaking down. The December 27th SEC filing revealed the cost of that recognition. $4.875 billion in unrealized losses, meaning the positions remained on the bank's books but had declined so dramatically in value that they required disclosure. The bank's stock price dropped 3.2% in after-hours trading, despite the broader market being closed for the Christmas holiday period. Bond credit default swaps, insurance contracts against JP Morgan's potential default, widened by 15 basis points, the largest single-day move in over a year. But perhaps the most significant development came from information leaked to financial journalists over the weekend. According to sources described as familiar with the matter, the Federal Reserve had scheduled an emergency meeting of the Federal Open Market Committee, something that occurs only during financial crises requiring immediate intervention. The last such emergency meeting happened in March 2020 during the COVID-19 market panic, when the Fed slashed interest rates to zero and launched unlimited quantitative easing. What could possibly require emergency Fed intervention in late December 2025? The answer lies in the interconnected nature of modern financial markets and the staggering scale of derivative exposures that most people never see. According to the Office of the Comptroller of the Currency's Q4 2024 derivatives report, the U.S. banking system held approximately $173 trillion in notional derivatives exposure. The word notional is important. It represents the face value of contracts, not the actual money at risk. But even the net credit exposure after netting and collateral exceeded $270 billion. 4 banks, JP Morgan, Goldman Sachs, Citibank, and Bank of America, control 87.6% of all derivatives held by U.S. commercial banks. These derivatives span every asset class: interest rates, foreign exchange, equities, commodities, and credit. They exist as hedges, speculative positions, and complex structured products sold to clients ranging from pension funds to sovereign wealth funds. And they are all interconnected, tied together through counterparty relationships, collateral chains, and correlation assumptions that work perfectly in models but can fail catastrophically in reality. Silver derivatives represent a tiny fraction of this market by notional value, perhaps $200 billion globally across all exchanges and over-the-counter contracts. But their importance vastly exceeds their size because of what they reveal about physical commodity markets and the assumptions underpinning the entire financial architecture. For decades, the operating assumption in commodity derivatives has been that physical delivery is rare, that most contracts settle financially, and that exchanges maintain sufficient inventories to handle the small percentage of contracts demanding actual metal. This assumption allowed exchanges to operate with a fractional reserve system, where the number of paper claims on silver vastly exceeds the physical metal available to deliver. Consider the numbers. Open interest in COMEX silver futures in December 2025 represented approximately 850 million ounces. Registered COMEX inventories, metal immediately available for delivery, stood at approximately 140 million ounces before the December squeeze. Simple division reveals a ratio of 6 to 1. 6 paper claims for every physical ounce available, and that's just the COMEX. When you include over-the-counter derivatives, bank unallocated accounts, and exchange-traded products that may not hold full backing, estimates suggest the ratio could exceed 10 to 1 globally. The system functions smoothly until the day it doesn't. Until the day when buyers stop accepting cash settlement and demand physical delivery. Until the day when industrial consumers decide they cannot risk supply disruption and begin accumulating strategic inventories. Until the day when the marginal physical ounce becomes more valuable than any paper contract promising future delivery. December 2025 appears to have been that day. The broader implications extend far beyond silver. If physical commodity markets can decouple from paper derivatives, if buyers refuse to honor the implicit social contract that paper and physical are equivalent, then every commodity market faces potential disruption. Oil, copper, platinum, wheat, soybeans, all trade with similar fractional reserve structures, where paper claims vastly exceed immediately available physical supply. More fundamentally, the crisis reveals something about the nature of modern monetary systems. Since 1971, when President Nixon closed the gold window and ended the dollar's convertibility to gold, global currencies have operated as pure fiat money backed only by government decree and economic confidence. This system has enabled unprecedented credit expansion, allowed central banks to conduct monetary policy without physical constraints, and funded decades of deficit spending that would have been impossible under a commodity-based monetary standard. But fiat money systems carry an inherent vulnerability. They depend entirely on confidence. Confidence that inflation will remain controlled, that governments will maintain fiscal discipline, that central banks will preserve purchasing power, that paper claims will remain as good as physical assets. When that confidence erodes, even in small, specific markets like silver, the implications cascade outward. Central banks appear to recognize this vulnerability. According to the World Gold Council's 2025 Central Bank Gold Reserve Survey, monetary authorities purchased over 1,000 tons of gold in both 2023 and 2024, the highest levels in modern history. Poland added 67 tons in 2025 alone. China, though it paused official purchases mid-year, holds over 2,264 tons in reserves. The Reserve Bank of India increased holdings by 72.6 tons in 2024. For the first time in decades, 2025 marked the year when central banks collectively held more reserves in gold than in U.S. Treasury securities. A historic reversal, suggesting profound doubt about the long-term stability of dollar-denominated assets. These institutions aren't buying paper gold derivatives. They're repatriating physical metal to domestic vaults, implementing security protocols that rival nuclear weapon storage, and making clear through actions, if not words, that tangible assets matter when confidence fails. The silver crisis is occurring within this broader context of monetary system stress. U.S. federal debt exceeded $36 trillion in 2025, with annual deficit spending exceeding $2 trillion, despite a strong economy, a fiscal position that historically occurs only during recessions or wars. Japan's debt-to-GDP ratio surpassed 260%. European banks remained undercapitalized relative to U.S. standards, carrying derivative exposures that dwarf their tangible equity. And now, in late December 2025, the world's largest bank is revealing multi-billion-dollar losses on positions in a metal market so small that total annual production is worth approximately $70 billion. The mathematics shouldn't allow this, unless the leverage and exposure were so extreme that even small moves in a minor commodity could threaten institutional stability. Three scenarios dominate discussions among market participants, each with profoundly different implications for the financial system and precious metals prices. Understanding these scenarios requires separating what institutions say publicly from what their actions reveal privately. Scenario 1, regulatory intervention. This is the playbook from 1980, the solution that saved the system during the Hunt brothers crisis. Exchanges could implement position limits that force large holders to liquidate, increase margin requirements to make speculation prohibitively expensive, or even suspend trading temporarily to allow orderly market conditions to return. Governments could invoke emergency powers, perhaps arguing that silver's role in military and technological infrastructure constitutes a national security concern requiring temporary market controls. The difficulty with this scenario in 2025 is that the demand isn't coming from individual speculators making leveraged bets. It's coming from industrial consumers with genuine needs, sovereign entities making strategic decisions, and investors responding rationally to supply-demand fundamentals. How do you regulate away structural deficits? How do you force solar panel manufacturers to reduce silver content when the technology requires it? How do you convince central banks that paper claims are as good as physical metal when those same banks are actively repatriating gold precisely because paper claims failed? Scenario 2, market capitulation. In this outcome, the short positions held by banks like JP Morgan become untenable, forced to close at massive losses. The resulting buying pressure pushes silver to prices that fundamentally alter industrial economics, perhaps $100 per ounce, perhaps higher. At such levels, substitution becomes economically viable even where technically challenging. Companies invest in research to reduce silver content in solar cells. Electrical contacts use more copper. Despite lower performance, supply responses accelerate as dormant mines restart operations and exploration expands. This scenario mirrors what happened with other commodity squeezes throughout history. Rhodium reaching over $29,000 per ounce in 2021 before collapsing 90% as users found alternatives, palladium spiking to $3,000 before demand destruction and substitution kicked in, even lumber surging over $1,600 per thousand board feet during COVID-19 supply chain disruptions before crashing back to normal ranges. The challenge is timing. How long does the squeeze last before supply responses and demand destruction rebalance the market? How much damage occurs to financial institutions and derivative markets in the interim? And most importantly, does the silver crisis remain contained, or does it trigger reassessments of other commodity markets and broader questions about the reliability of paper derivatives? Scenario 3, systemic recognition. This is the outcome few analysts discuss publicly, but many consider privately. In this scenario, the silver crisis becomes a catalyst for broader recognition that the fractional reserve structure of commodity derivatives has become unsustainable, that the disconnect between paper claims and physical assets represents systemic risk rather than isolated market stress. Under this scenario, we see a multi-year process of re-physicalization, a market structure evolution where physical delivery becomes the norm rather than an exception, where storage costs and transportation logistics matter again, where the dominance of financial centers like New York and London gets challenged by physical trading hubs closer to production and consumption. This would represent a fundamental shift in how commodity markets operate, reducing financial efficiency but increasing physical resilience. The implications for precious metals prices in this scenario are profound. If paper derivatives lose their ability to suppress physical prices through unlimited short selling backed by minimal metal, if investors demand allocated physical holdings rather than unallocated bank accounts, if industrial consumers build strategic inventories rather than relying on just-in-time delivery, then the price discovery mechanism shifts dramatically toward scarcity value. Gold and silver would increasingly price based on their role as monetary alternatives rather than industrial commodities. Gold might approach $5,000 per ounce or higher as central banks continue accumulating, and wealthy individuals seek inflation protection that governments cannot confiscate through monetary policy. Silver, with its dual role as both industrial and monetary metal, could see even more dramatic appreciation if industrial demand continues growing while investment demand accelerates. Current market positioning suggests many sophisticated players are betting on some version of Scenario 3. JP Morgan A or S reversal from massive short to massive long position represents a $50 billion bet that physical silver will appreciate significantly. Central banks loading up on gold rather than U.S. treasuries represents a multi-trillion-dollar shift away from dollar confidence. Retail investors accumulating silver coins and bars despite premiums exceeding 20% above spot prices suggests grassroots recognition that paper and physical are not equivalent. The emergency Federal Reserve meeting rumored for early January 2026 may be attempting to prevent Scenario 3 from materializing. The Fed's toolkit includes liquidity injections to banks facing derivative losses, coordinated intervention with foreign central banks to stabilize precious metals markets, possibly even emergency regulatory changes to restrict physical delivery demands on exchanges. But there's a fundamental problem with all attempted interventions. They require confidence in the system, its ability to manage the crisis. Every time authorities step in to prevent markets from clearing at natural prices, they reinforce the perception that the system cannot function without intervention. And eventually, market participants stop trusting that intervention will work. We may be approaching that moment. The silver market, small, overlooked, dismissed by most mainstream analysts as irrelevant, might be the canary in the coal mine, signaling that the age of unlimited paper money backed by nothing more than confidence is entering a dangerous phase. Here's the insight that most analysis misses: the narrative around JP Morgan-S losses. And the silver squeeze focuses on market mechanics, supply deficits, derivative exposures, delivery pressures. These are real and important, but they are symptoms, not causes. The deeper story is about trust. For over 50 years, global financial markets have operated on a simple premise: paper claims are as good as physical assets because the system will always allow conversion at predictable prices. You can own a gold ETF instead of bullion because the fund promises deliverability. You can accept dollar payment instead of physical goods because dollars reliably exchange for goods. You can trust derivative contracts because exchanges guarantee settlement. This premise has enabled extraordinary financial innovation and economic growth. Credit expansion, leveraged investing, complex derivatives, just-in-time manufacturing, global supply chains, all depend on trust that paper. And physical remain equivalent, that promises are kept, that the system functions smoothly. But trust is not a physical law, it is a social construct, maintained through consistent behavior and shattered by repeated failures. Each time the system fails to deliver physical when demanded, whether silver on the COMEX, treasury securities during repo market stress, bank deposits during runs, trust erodes incrementally. December 2025 may be remembered as the moment when trust began failing in precious metals markets, when paper and physical officially decoupled, when the largest bank in America admitted it was on the wrong side of history. If so, the implications extend far beyond one metal or one bank. They suggest a broader realignment toward physical assets and away from financial claims, toward tangible wealth and away from paper promises, toward systems that have endured for millennia and away from experiments barely 50 years old. The contrarian insight is this: the crisis is not about silver. The crisis is about whether the financial system's operating assumptions remain valid in a world where confidence is fragmenting, where central banks have lost control of inflation and debt, where the gap between paper claims and physical reality grows wider every day. Silver just happens to be where the fault line broke first. But fault lines, once broken, rarely stop at the initial rupture point. They propagate, stress redistributes, and structures built on unstable foundations reveal their weaknesses in cascade fashion. JP Morgan's $4.875 billion loss is not the end of the story. It is the beginning. What comes next will determine whether precious metals remain historical curiosities or reclaim their role as money in a world that desperately needs something that cannot be printed, manipulated, or defaulted upon. The market is about to provide an answer, and that answer will reshape the financial landscape for decades to come.